Hi everyone, welcome to another episode of Insurance Simplified with Ironrock. I'm your host Christian Watt, Ironrock's General Manager for Marketing and Production. Today we're going to talk about a topic that is a little off course from insurance. As we promised you, we're going to bring more and more content that's related to insurance stuff, but not necessarily direct insurance material. So it's a topic that I've been thinking about for quite some time. I've seen this incredible trend in the market where we have motor vehicle loans being offered for 8, 9, 10 years. I think you can get them up to 10 years now, and the interest rates coming down with them. And I just wanted to talk about that a bit today and what that means for you, for your personal wealth creation, for your risk, and ultimately for potentially your insurance policy. You would think, motor vehicle loan, what does that have to do with my insurance policy? Well, if you've borrowed money for a car recently or bought a car recently, you would know that you have to get an insurance policy, a comprehensive insurance policy, before the bank issues that loan. The reason is they want to protect their asset. They want to make sure that if anything happens to it, that they can get a payout to cover the loan from theft or collision or whatever it is. So we all know that insurance and motor vehicle loans are interconnected. And so we wanted to spend a little time talking about exactly where this trend is going, if it will stop, when it will stop, and what does it mean for you. A disclaimer, I have nothing against motor vehicle loans. It's the second largest asset that most people ever buy, next to their house being the first. Most people can't buy a car cash. You have to go to the bank to get a loan. And so it's a reasonable thing that you need to go and get a loan. It's a good thing to go and, secure funding to go and get your car. Some people want to get their dream car. Again, nothing wrong with that. But what we want to talk about today is doing that smartly. And how do you do that in the context of creating your wealth and improving your net worth? So let's talk about the meat of this matter, these extended loans for 8, 9, 10 years, 100% financing, and why that could be a potential issue for you, or why we think it's an issue. When you drive a new car off the lot, everybody has heard this before, the minute you drive off the lot, the car loses X amount of value. It might be 10 in some cases, 15, up to 20% the day you drive it off the lot. So when you take a 100% finance loan for a motor vehicle, that the minute you drive it off the lot, you've lost 10, 15, 20% of value, what that means is you're behind the 8 ball, or you're in the drink for your loan. You don't have any equity in the car yet. And with a 10-year loan at 100% financing, that could be up to 5 years before you actually see equity in the car. What does that mean? If you were to sell the car before that benchmark, you would still owe the bank money. The market value of the car moves down and it depreciates faster than you pay off a 10-year loan. So we're just bringing this to our audience today for you to think about before you jump into your next motor vehicle loan. So we just want you to think about the best way, the smartest way to accomplish the purchase of your next motor vehicle, right? It's not necessarily about buying the greatest and the latest. And we know Jamaicans have an insatiable appetite for buying the latest car. It's a status symbol. It's a success symbol when we can buy our luxury cars. And the banks have made it affordable. And that's a good thing, to make loans more affordable. But also, we all have to look at our personal circumstances, not just because you can afford the cash flow of the monthly payment based on that 100% means you necessarily should go and buy that luxury or dream car right now. You need to assess your full financial position. So what that means is, what's the exposure you have when you buy that $12 or $14 million car because you can afford the $100,000 a month payment as per the debt service ratio. But when you drive off the lot, within that first year, that $12 million car is now worth 11 or 10.5 million. your loan is not going to be 11 or 10.5 million after 1 year. You can run an amortization, use any app, look it up in the App Store, the Google Play Store, and find a loan app and just run the amortization on it. And you'll see your loan balance as the years go on. On a 10-year, 100% finance loan, it'll take you about 5 years before you get into equity, meaning that's when you can sell the car and actually have some left back after you've paid off the loan. What do people say? It's my dream car. I'm not going to be selling it in the first year or two. Yeah, that's fine, but there's a second part to the risk. What if something happens that forces you to? Loss of job, cutting income. Maybe you're self-employed and some clients have cut back, so you've lost some income and you can no longer afford that. So you need to liquidate the asset to pay off the bank. When you do so, you'll end up paying them off and not having enough to clear the loan. Further, what about with the insurance? So let's say you had a loss. It doesn't have to be your fault. Remember, an accident is just that. It's an accident. Let's say somebody runs into you, writes off your car, they don't have insurance. So you need to claim on your policy. And you had this $12 million car. It happens in the first year. Insurance company is going to pay out the market value of the car, which because of depreciation right away is 11 or 10.5 million. So that gets paid out to the bank because there's a mortgage interest on the policy. And the balance of the loan, which could very well be another $1 million, is left in your lap to pay. So that's the risk you're taking when you do that 100% financing for a 10-year loan, 8, 9, 10 years. It takes a very long time to get down into the equity of the car. And our whole point of this conversation is just to raise awareness on it for people to think about it. They say that the fastest way to not create wealth is to create and extend debt. So what we don't want our customers doing is overextending themselves to keep up with the Joneses or to say that they have achieved the status symbol of owning the latest car, but we want you to own it really responsibly. So think about, we're not saying not buy those cars, we're just saying think about putting down a deposit instead. Put down a 10% deposit, save a little bit. That way you can cover some of that first year's depreciation so that you stay in line with your loan as the car depreciates. Think about buying a car that's a year, 2, 3 years older if you can't afford the deposit on a brand new car. So a lot of our dealers have used car departments or entire companies dedicated to the trading value of their used cars. Those are great spots to start. So you can still get your luxury car and the car of your dreams, but just do it responsibly. We just want you to think through your next car loan decision. And we hope that this conversation helps everyone to do that. We thank you for tuning in to another episode of Insurance Simplified. Remember to follow us on YouTube, subscribe, follow us on Instagram, Facebook. It's Iron Rock Jamaica on Instagram and Iron Rock Insurance on Facebook. Remember to comment on this, share this with your friends, share this with that next person that's about to buy a new car so that they can think about it. You might just save somebody's generational wealth creation plan. So thanks again. Tune in next time.